Imagine your house has this one single master thermostat. And it doesn't just control the temperature in your living room.
Right.
It actually dictates, the price of your groceries, the value of your house, the interest on your credit card, and even whether your neighbor gets to keep their job.
Oh, wow. Yeah.
Right. Like you'd probably watch that thermostat like a hawk.
Oh, absolutely.
Yeah.
I mean, whoever is turning that dial is essentially deciding the financial weather for everyone inside.
Exactly. And right now, the hands on that dial are moving. We are looking at the highly anticipated 2026 Federal Reserve interest rate cuts.
Which is huge.
It is. So for this deep dive, we're looking at a pretty massive stack of sources. We've got financial projections, Fed policies, market data, and our mission today is to cut through all the textbook jargon. We want to figure out exactly what these changes mean for your actual wallet.
Yeah, we need to see who really wins here and, who is quietly paying the price.
Right. Okay. Let's unpack this. Because the Fed isn't some shadowy organization, right? They're basically the bank's bank. When regular banks need money, they go to the Fed.
Exactly. And the Fed has, well, one primary tool at its disposal to manage the economy, which is controlling the federal funds rate.
Okay, the federal funds rate, what is that exactly?
So it's just the interest rate that banks charge each other when they lend money overnight. I know it sounds like this purely behind-the-scenes banking metric.
Yeah, it sounds pretty dry, I mean.
It does, but it is actually the single most powerful number in the economy.
Wait, really? Just that one overnight rate?
Yep, because when the Fed raises that rate, borrowing across the board becomes expensive. I mean, people buy fewer homes, businesses hold off on expanding, and the whole economy just sort of slows down.
Gotcha. So then, obviously, cutting rates does the exact opposite.
Right. Borrowing becomes cheaper, money flows, people buy more, businesses expand, and, the economy heats up.
Okay, so if the Fed is telegraphing rate cuts for 2026, they're basically walking over to that master thermostat and saying, we want to pump money into the room, let's heat things up.
Exactly.
But to understand why we are getting these cuts right now, I mean, we have to look backward at the cause and effect roller coaster of the last few years.
Yeah, we really do.
Because the sources remind us of the brutal inflation of 2021 and 2022. I
Right.
mean, gas jumped from, what, $3 to $5?
Right, and the cost of basic groceries basically doubled. It was painful.
So painful. So how did the Fed react to that?
Well, their response to that exploding inflation was basically a blunt instrument. They cranked interest rates up from near zero to over 5% in less than a year.
Wow.
Yeah, it was one of the fastest rate hike cycles in modern history. The logic was clear, make borrowing highly expensive to force people to spend less, kill the demand so prices would eventually stabilize.
Wait, let me push back on that timeline, though, because by 2025, inflation was actually cooling off, right?
It was, yeah.
Prices weren't rising at that terrifying speed anymore, so the medicine worked. Mission accomplished, right? Why mess with the rates again in 2026? Why not just leave the thermostat alone?
Well, what's fascinating here is the really delicate balancing act the Fed has to perform. High rates don't just kill inflation, they kill jobs and they stall businesses.
Oh, I see.
Think of the economy like a massive hydroelectric dam. The Fed slammed the floodgates closed to stop the surging, destructive waters of inflation.
Okay, that makes sense.
But now the water level behind the dam is dropping. If they leave those massive steel gates closed for too long, the river downstream dries up completely.
And that drought is a recession.
Exactly. So the 2026 cuts are really a preemptive strike. They are opening the floodgates just a crack to let some liquidity back into the river before that drought actually hits.
Okay, so that water flowing downstream hits the biggest thing most of us will ever borrow money for first, which is a house.
Oh, yeah. Real estate.
Let's look at the hard math from our sources because this is wild. Say you were looking to buy a house that costs $400,000.
Okay.
At a 7% interest rate over 30 years, your monthly mortgage payment sits around $2,660.
Right. Pretty hefty.
But if the Fed cuts rates and your mortgage drops to 5.5%, that same monthly payment falls to about $2,270.
Oh, wow.
Yeah, that is a savings of almost $400 every single month. I mean, over a 30-year loan, you are saving over $140,000.
That's incredible.
Right. It sounds like a massive discount, like this exclusive sale where everything is suddenly cheaper. But is it?
Well, no. The data reveals a pretty powerful paradox that complicates that whole discount idea.
Okay, what's the catch?
The catch is that cheaper borrowing instantly increases demand. So when mortgage rates drop to 5.5%, thousands of buyers who were priced out at 7% suddenly qualify for a loan.
Oh man, so they start flooding back into the market.
Exactly. You show up to an open house for that $400,000 property, and instead of competing with, three other buyers, you're competing with 30.
Which inevitably sparks a massive bidding war.
Right. And the sheer volume of buyers drives the actual sticker price of a house up.
Yeah.
So sure, the bank might be charging you less interest every month, but you are forced to take on a significantly larger principal loan just to win the bid.
That is incredibly frustrating for first-time buyers trying to enter the market. The monthly payment falls, but the total debt you have to shoulder is just so much heavier.
It really is. But our sources do highlight one group for whom this is unambiguously fantastic news.
Let me guess. Existing homeowners.
Nailed it. If you already have a fixed-rate mortgage locked in at 7%, your house price is already set in stone. You don't have to bid again.
Right. You can just refinance down to 5.5%, essentially trading your expensive loan for a cheaper one.
Exactly. You keep the house, you dodge the bidding war entirely, and you free up hundreds of dollars a month in pure cash flow.
So homeowners who bought during the high-rate years are basically positioned to reap massive benefits here. It really seems like the system rewards those who already hold the asset.
It does. It really, really does.
Well, if homeowners are getting a structural break, I feel like we need to talk about the debt that is sitting in my wallet right now. Credit cards!
Oh, yeah? The plastic trap.
Right, because the sources point out a deeply frustrating dynamic with these variable annual percentage rates, or APRs. When the Fed was hiking rates aggressively in 2024 and 2025, credit card companies passed those rate hikes on to consumers instantly.
Almost overnight, yeah.
Within weeks, people saw their interest payments spike. So my question is, if they can raise the rates on us in a matter of days when the Fed hikes, how fast are they going to lower our APR now that the Fed is cutting rates?
Yeah, I have some bad news for you there. Financial institutions are notoriously deliberately sluggish when it comes to passing rate cuts back to the consumer.
Of course they are.
Yeah, banks use this transitional period to pad their profit margins. I mean, the money becomes cheaper for them to borrow overnight, but they maintain that inflated, 24% rate on your consumer debt for as long as they can justify it.
Wow. So how long does it usually take to see a drop?
Historically, consumers have had to wait well over a year to see any meaningful relief on their statements. The projections for this cycle suggest you might not see significantly lower credit card rates until late 2026 or even 2027.
That feels entirely lopsided, like they just pocket the spread while I keep paying the premium.
It is lopsided, but there is a direct countermeasure you can take.
Okay, I'm taking notes. What do I do?
Get your credit card company on the phone. Literally call them up. Cite the Fed's recent rate cuts explicitly and tell them their competitors are offering better balance transfer rates.
Really? Does it actually work?
It does. Forcing the issue often yields immediate reductions during these macroeconomic transitions.
So the squeaky wheel gets the lower APR. Good to know. But, even if I negotiate them down from 24% to 18%, the sources hit on a golden rule here.
Pay it off.
Yes. Revolving credit card debt is mathematically toxic. It is just too expensive to carry, regardless of the broader economic environment.
Absolutely. Do not wait for the Fed to save your Visa bill. Pay it off as aggressively as possible.
Yeah, relying on macroeconomic policy to fix a personal balance sheet feels like a losing strategy. The math of compounded high-interest debt is always going to outpace any benefit a Fed cut might eventually offer.
Exactly. You just can't beat that compound interest working against you.
Right. Well, that sluggishness from the banks on credit cards makes me want to hold on tighter to the cash I actually have. So let's look at how rate cuts change the fundamental math of saving and investing.
This is a really interesting shift.
Yeah, because over the last couple of years, being a saver was highly lucrative. In 2023 and 2024, you could easily find high-yield savings accounts paying 5% APY.
Right, which is fantastic.
It was. I mean, if you had $10,000 sitting in that account, you were making $500 a year, just for letting your money take a nap.
Pretty sweet deal.
But with the Fed cutting rates, that yield might drop to 2.5%. Your return gets slashed in half down to $250.
Yeah, that stinks.
It does. And if I'm watching my guaranteed returns get cut in half, my immediate instinct is to yank my money out of that savings account and go chase better returns in the stock market. Why shouldn't I just empty the account?
Well, following that instinct blindly kind of ignores the context of why the Fed is cutting rates in the first place.
Okay, what do you mean?
The cuts signal that the economy is showing signs of weakness.
Right.
They're trying to prevent a recession, but a soft landing is never guaranteed.
Right, it could still get bumpy.
Exactly.
Yeah.
So keeping a solid chunk of cash in a high-yield savings account isn't about maximizing your yield anymore. It's about structural ballast.
Ballast. I like that.
Yeah, a 2.5% guaranteed return acts as a vital cushion against a volatile stock market. I mean, that market could easily drop 20% if the economy hits a severe speed bump.
Okay, so I'm not keeping it there to get rich. I'm keeping it there so I don't have to sell stocks at a massive loss just to pay for a sudden emergency.
Exactly. It's your safety net.
Makes sense.
Mhm.
But for the money I am investing, the sources detail a shift into what they call a risk-on environment.
Right. And here we have to look at the psychology and the math of risk.
Okay.
When a completely safe savings account pays 5%, investors look at the stock market, which, historically returns roughly 8 to 12%, and they decide the extra few percentage points just aren't worth the potential volatility. So they park their money in cash.
Right. Why risk it for just a little bit more?
Exactly. But when the Fed cuts rates and that safe return drops to 2%, the calculus flips entirely. 2% just isn't enough to beat long-term inflation or reach your retirement goals.
So investors are basically forced to move their money back into riskier assets to chase higher yields.
Yes. Cash floods out of savings accounts and pours directly into stocks, crypto, and real estate.
And that massive influx of capital pushes the prices of those assets up.
Right. And tech stocks and growth companies specifically tend to win big in this kind of environment.
Why tech specifically?
Because these are companies whose valuations rely heavily on future profits. When interest rates fall, it becomes much cheaper for them to borrow money to fund their expansion.
Ah, so their future earnings look much more attractive to investors.
Exactly. Also, utilities and real estate investment trusts see a surge in demand, mainly because they often pay dividends. And dividends look highly appealing when traditional savings yields are collapsing.
Here's where it gets really interesting, though. Because economies are zero-sum, they don't magically create free value out of thin air.
That is a harsh but true reality.
We've spent a lot of time focusing on the winners here. People refinancing their homes, tech stocks surging, investors finding new wealth. But if someone is winning, someone else is quietly footing the bill.
They absolutely are.
So let's dig into the hitting losers in this 2026 rate cut cycle. Because if savers are watching their yields get slashed, I have to assume anyone living on a fixed income is taking a direct hit.
Yeah, retirees are arguably the most exposed group here. I mean, if you spent your entire life building a nest egg and you structured your retirement to live off the fixed interest generated by bonds or savings, falling rates are just devastating.
Because your actual income drops.
Exactly. If your portfolio's yield drops from 5% to 3%, your daily spending power literally shrinks. Your grocery budget gets tighter simply because the Fed decided the broader economy needed a stimulus.
Man, that's rough. And I suppose if savers are losing, anyone who lends money for a living is caught in the same trap, right?
Yep, absolutely.
Like, if I loaned out money at an 8% interest rate and the market drops to 4%, the borrower is just going to refinance. They pay me off early, and I am suddenly deprived of the high-yield asset I thought I had secured.
Right. The lenders lose their premium margin. But the third group of losers faces a much darker macroeconomic reality.
Yeah.
And that's everyday workers.
Really? How so?
Well, we have to remember that the Fed is cutting rates because they are worried. They're worried that the heavy brake pressure they applied in 2023 and 2024 might stall the economic engine entirely.
Right, the whole damn drying up analogy.
Exactly. So if this preemptive strike fails, if they don't achieve that perfect soft landing and a recession materializes anyway, workers pay the ultimate price.
Because that brings job losses, hiring freezes, wage stagnation. All of it sweeps through the economy.
Yes. And if you lose your primary source of income, the fact that mortgage rates are slightly lower doesn't help you at all.
Yeah, you aren't buying a house without a paycheck anyway.
Exactly. Now, the fourth hidden loser identified in the sources is the most complex, and it operates on a massive scale. And that is the federal government itself.
Wait, let me stop you right there because the U.S. government is the biggest borrower on the planet. They hold trillions in national debt.
They sure do.
So if interest rates fall, it becomes cheaper to borrow. The government should be thrilled that rates are dropping. How could they possibly lose?
Well, let's break down the actual mechanism of how the government borrows. Because they don't walk into a bank and take out a loan. They issue treasury bonds.
Okay.
They need institutional investors, foreign governments, and everyday citizens to actually buy those bonds.
Yeah.
During high interest periods, investors flock to Treasury bonds because they offer a fantastic risk-free return, say 5%.
So when the Fed cuts rates, the yield on newly issued government bonds falls alongside everything else.
Exactly.
So the government is standing there saying, please buy our debt, we'll pay you 3% instead of 5.
Right. And a massive portion of those investors look at that 3% and decide to take their capital to the stock market instead, chasing the risk-on returns we discussed earlier.
Oh, wow. So demand for government debt just dries up.
It does. But the government still has a massive, ongoing deficit. They still need that funding to keep infrastructure running, fund the military, pay for social programs. If they cannot easily sell bonds because the interest rate is too low to attract buyers, they face a severe funding gap.
Which leaves them with terrible options, I'm guessing?
Very terrible. They either have to print more money, which obviously risks sparking the very inflation the Fed just spent 3 years fighting, or they are forced to drastically raise taxes and cut public spending to make up the shortfall.
Wow. Okay, I never thought of it that way.
Yeah, if we connect this to the bigger picture, the Federal Reserve is essentially performing open-heart surgery on the economy while the patient is awake and walking around.
That is a terrifying image.
It kind of is. They are trying to make borrowing cheaper to stimulate growth without crashing the demand for U.S. debt, without devastating retirees, and without triggering a recession. I mean, getting any part of this equation wrong has cascading, severe consequences for everyday people.
So what does this all mean for you? Let's synthesize the baseline reality for 2026 based on the projections in our sources.
Let's do it.
It looks like we are looking at 3 to 4 gradual rate cuts throughout the year. It's a slow step down, not a sudden cliff. Mortgage rates are expected to settle somewhere between 5 and 6%, with inflation remaining relatively stable.
That's the baseline.
Given everything we've unpacked, the action plan here feels, well, aggressively unglamorous. For instance, if I'm holding a high-interest credit card balance, I'm not waiting for a sluggish bank to pass along a 2% Fed cut in 2027. I'm killing that balance today.
That is hands down the most mathematically sound decision you can make in any rate environment.
And for homeowners or prospective buyers, mid-2026 looks like the strategic window to begin seriously analyzing your refinancing options.
Right. You don't want to pull the trigger immediately on the very first cut, but you definitely need to be tracking that downward trend closely.
And for my investments, I'm keeping my emergency fund in that high-yield savings account as the structural ballast we talked about. I'll gladly take the 2.5% return over 0% in a basic checking account.
Smart move.
But I'm going to keep dollar cost averaging my investments into the market. I'm not trying to day trade the Fed's press conferences.
Yeah, please don't. The Fed's mandate is macroeconomic stability. Their job is to keep the aggregate machine of the U.S. economy running. It is absolutely not to optimize your personal portfolio.
Right. They aren't looking at my brokerage account.
No, they aren't. You have to make decisions based on your specific financial reality and your risk tolerance. Consistency, patience, and maintaining a well-diversified strategy will always outperform attempts to perfectly time the market based on, an interest rate whisper.
I want to leave you with one final provocative thought to chew on before we go. Something the sources hint at, but that we really need to sit with. We talked about how lower rates make borrowing cheaper, but inevitably push the prices of assets like houses and stocks even higher.
Right, because the demand side of the equation inherently drives up asset valuations.
So if every time the Fed lowers the temperature on that master thermostat, the people who already own the houses and the stock portfolios see their net worth explode, while the people trying to buy their first home are faced with even higher sticker prices. I mean, are these rate cuts actually saving the economy, or are they just quietly, efficiently widening the wealth gap between those who already own assets and those who are still desperately trying to buy their first?
And that's the big question, isn't it?
Yeah.
It suggests that while the Fed might adjust the thermostat to keep the house from freezing, not everyone is actually allowed near the fire.
Exactly. Keep an eye on that dial. Until next time.